Thank you for tuning into the webinar today on impact of VAT on designated zones in the UAE. I'm Rajeshri from the Zoho Books team. Most of you here will be knowing Zoho Books, but for the benefit of those who are new and trial users, Zoho Books is our VAT compliant accounting software which helps businesses manage their finances. We have with us Mayank Soni, who is the presenter for today. We have him with us for the second time now, and for those of you who are not familiar, he is the Managing Director of Max Growth Limited and Max Growth Consulting. He is also a corporate finance and consulting professional with over 19 years of expertise on VAT advisory, international taxation advisory, and private equity. He has worked with large MNCs and government organizations such as the Office of His Highness, the Crown Prince of Dubai. And you can find his articles and columns on VAT in College Times and Gulf News. He's a well-recognized VAT expert and a member of the Indirect Tax Committee of ICAI in the UAE, responsible for evaluation and training for ICAI's certification courses on GCC and UAE VAT. Today, we have him sharing with us his insights on the various aspects of VAT and its impact on businesses carried out in designated zones. On behalf of all of you, I welcome you, Mayank. And without further delay, let me hand over the webinar to the speaker.
This is Mayank Sahani. I'm the Managing Director for Max Growth Limited and Max Growth Consulting. We are one of the leading chartered accountants firm in UAE, which is practicing into VAT advisory. And we are happy with this partnership with Zoho Books to share our views and thoughts on various areas of VAT law in UAE with all of you. Today, what we are going to discuss is one of the most critical areas of VAT in UAE. That's the impact of VAT on the designated zones in UAE. We'll start our session understanding the various sections and the provisions of the VAT decree law and the VAT executive regulations, which cover the provisions which govern the designated zones in UAE. The first and the most important provision is the Article 1 of the UAE law, which defines designated zone as any area specified by a cabinet decision and considered to be outside the UAE for tax purposes. Now, important part in this definition is, although the definition says the designated zones are considered as outside UAE for tax purposes, but as a matter of fact, the way the overall law has been drafted, for certain purposes, the designated zones are considered to be outside of the UAE, and for certain purposes, they are considered to be within UAE. And that is what we are going to discuss point by point, when they are considered outside UAE and when they're considered within UAE, as far as the application of the VAT law is concerned. So the next article, which is important in understanding the designated zone, is the Article 51 of the UAE law, which provides that the goods may be transferred from one designated zone to another designated zone or within a designated zone itself without any tax becoming due on it, which means if there is a movement of goods between two designated zone companies, or there's a movement of goods between companies within the designated zone, then such transactions are outside the scope of the UAE VAT. The zones which qualify to be designated zones are defined by a cabinet decision. The first cabinet decision to this effect came into the public domain on 9th of January 2018. However, the effective date of this decision was 28th of December 2018, and the designated zones came into effect from 1st of January 2018 itself, which was the date on which the VAT law of UAE became effective. The executive regulations provide the procedures and the conditions for the transfer of goods and the method of keeping, storing, and processing such goods. What is important for any zone in UAE to qualify as a designated zone The onus is on the authorities regulating and governing that zone to ensure that all safety procedures are taken into consideration to ensure that there is no leakage of revenue to the federal tax authority from their zone. So, which means they have to ensure there is no unauthorized movement of goods out of the designated zones or into the designated zones without the due payment of VAT as well as the custom duty having been made, depending on what kind of a transaction it is. The executive regulations also define in the situations when the transactions of designated zone companies are considered to be taking place within UAE. Next, we move into the second aspect of VATs as far as designated zones is concerned. What happens when the designated zones they do transactions with countries outside of UAE? The first rule is that any import of goods by a designated zone in from a country outside of UAE is not subject to VAT. The reason being, such transactions are considered as outside the scope of UAE VAT because for such purposes, the designated zones are not considered to be coming within the territory of UAE. And since they're outside the territory of UAE, there is no VAT which is applicable. The same applies even in case of customs, as you all might be aware. In case of customs, if the import is made by a designated zone company or by even a free zone company which is not defined or qualified as a designated zone as per the VAT law, in all free zones, there is no custom duty which is applicable. However, as far as the VAT is concerned, the benefit is only applicable to the 23 zones which have been specifically defined by the cabinet decision to be designated zones. However, once the goods are transacted from a designated zone and they move into a mainland of UAE or they move into a free zone which is not a designated zone, then the VAT as well as custom duty becomes applicable. The custom duty has to be paid in either of the scenarios. However, for VAT, there are two different alternative mechanisms available. The first mechanism is if upon clearing of the goods from a designated zone into the mainland, the goods are cleared under the import code and the TRN of the buyer of those goods that is treated as an importer. In that case, the buyer does not have to pay the VAT, but he can account for the VAT under reverse charge mechanism. We will discuss more about reverse charge mechanism as we move forward on our presentation. However, in a similar scenario, if the goods are transacted from a designated zone company to a mainland company, but under the import code and the TRN of the seller, which is the designated zone company, in that case, it is an obligation of the designated zone company to charge 5% VAT to its buyer in the mainland, collect that 5% VAT from them, and pay that VAT to the federal tax authority as along with the submission of their VAT return. So these are the two alternative scenarios which are applicable as far as the VAT is concerned when the goods move from designated zone to mainland. And what is important to analyze is whether the goods have moved under the import code and the TRN of the buyer, or they have moved under the import code and the TRN of the seller. So the detailed procedures and treatments for each and every area has been defined in the executive regulations. We will try to summarize and simplify those provisions and explain it to you in very simple terms in this presentation. The Article 50 defines what is a designated zone. A designated zone is any zone that meets the conditions and criteria laid down in the executive regulations to qualify as a designated zone and which has been approved as a designated zone for purposes of VAT by the cabinet decision. Now, the conditions and criteria which is important to qualify as a designated zone is that there should be strict control over the movement of goods into a designated zone and out of the designated zone. Now, this strict control is maintained through custom checks or the custom gates which are there in all the designated zones. The designated zones, by and large, will be fenced designated zone, so they will have a proper fencing which allows the goods not to move in or out of them without without crossing that fence. However, there are certain designated zones which have been qualified as a designated zone without they really having a fencing because they were able to satisfy to the Federal Tax Authority that even without the fencing, they still have alternative mechanisms and procedures through which they can ensure proper control over movement of goods into designated zone and outside of the designated zone. And they take the responsibility that no goods will move without the VAT and the custom duty on such transactions being duly accounted for. And if they're able to satisfy the Federal Tax Authority on these things, they have been able to get themselves approved as designated zone. Although fencing is one of the important criteria, but we have seen in practice some of the designated zones have been qualified without having a fenced boundary surrounding them. But by and large, majority of the free zones which have been defined as designated zone, they are having a fencing to ensure this control. Now, in addition to VAT, we also have other indirect tax implications coming from the introduction of VAT. What is important to understand is the implication on the custom duty. Now, as we all know, historically, even before the VAT came into practice, when a designated zone company or a free zone company used to import the goods into UAE, they did not have to pay the 5% custom duty at the time of imports. In case they export the same goods to a country outside of UAE, the custom duty never becomes payable. The custom duty becomes payable only if such free zone company or the designated zone company sells these goods to a mainland company. In those cases, the 5% custom duty has to be paid at the times the goods are leaving the free zones or the designated zone. Generally, the custom duty or the import duty in UAE is a flat rate of 5%, and that is on the CIF value, which is the cost of the goods, the insurance, and the freight all taken together. That is what the 5% custom duty is applied on. The reason we are discussing this from the VAT perspective is because the VAT becomes applicable on the CIF value of the goods plus the 5% custom duty. For example, if the CIF value of goods is 100, the 5% custom duty charge on them is 5. Total CIF plus custom duty becomes 105. Then on this 105, the 5% VAT is applicable, which is equal to 5.25. Now this 5.25 AED of VAT will be accounted for under reverse charge mechanism if the mainland company which is buying these goods is registered for VAT in UAE, plus it also has got an import code, and the import code and the TRN are linked together, and the clearance of goods takes place under the import code and TRN of such buyer. In that case, instead of the seller accounting for the VAT, it will be the buyer who will account for the VAT on such transactions under the reverse charge mechanism. Generally, the custom duty I mentioned is a 5% flat rate. However, in case of certain items like tobacco and alcohol, they are subject to higher custom duty. Similarly, there are few items which are exempt from custom duty. So, if an item is exempt from custom duty, then the VAT is applicable only on the CIF value. because it is not necessary that if a product is exempt from custom duty, it will be also exempt from VAT. Even in case of the goods which are exempt from custom duty as per the UAE customs law, they still will be subject to VAT, and the VAT to be accounted for either by the buyer or by the seller, depending on under whose import code or under TRN are the goods cleared from the designated zone. A very important area of confusion amongst a lot of businesses in UAE is they intermix the designated zones for purposes of excise tax with the designated zones for the purposes of value added tax. Please understand that the cabinet decision and the list of designated zones for excise tax is a separate than the list of designated zones for VAT. So what is a designated zone under excise may not necessarily be also a designated zone for the purpose of VAT. And similarly, a designated zone for the purpose of VAT may not be necessarily a designated zone for purpose of excise. So if you are dealing in a business which is subject to both excise and VAT, please look at the list of designated zones provided under both the statutes separately and then apply the due treatment accordingly. The VAT on designated, implications on designated zones give rise to some of the most complex issues in the whole of the, I believe that's one of the most complicated areas as far as the VAT treatment is concerned, is how to apply the VAT treatment on transactions from designated zones and with designated zones. So the treatment or the impact is not only limited to designated zone companies, but it's also applicable for the companies in the mainland or other free zones which are not designated zones, which are dealing with these companies. So the understanding becomes mandatory more or less for each and every business, because there will be very few businesses in whole of UAE who do not have any transactions within the designated zones. The first thing which needs to be understood when you're doing a transaction with a company is if it's a free zone company, whether that free zone has been classified as a designated zone by the cabinet decision or not. Currently, there are more than 50 free zones in UAE. However, out of them, only 23 have been notified as a designated zone as per the cabinet decision. Therefore, when you're dealing with any free zone company, please look through the list of the designated zones and see whether that free zone is a designated zone or not. If a free zone is not a designated zone, then your transactions will be subject to exactly the same treatment which are applicable to the mainland company. There is no preferential treatment which is given to a free zone company which is not classified as designated zone as far as the VAT law is concerned. As far as the other area or the confusion which is there prevalent in a lot of businesses is they are applying the same treatment for transactions with designated zone without considering whether the transaction is a supply of goods or it is a supply of services. There are completely different set of provisions as far as supply of goods transactions with designated zones is concerned, which we have covered briefly so far, and the supply of services transactions. As far as the supply of services is concerned, there is no difference at all whether the services are being supplied by a designated zone company, a free zone company, or by a mainland company, or whether the services are received by either of these companies. The VAT treatment across UAE for every company, as far as receipt or supply of services is concerned, is exactly the same. There is not even a single difference. So as far as the designated zones differential treatment comes into play, it's only and only limited to supply of goods. Supply of services are exactly treated in the same way as they're treated for the mainland companies. Coming down to the supply of goods, the treatment for supply within one designated zone to a company within the same designated zone is outside the scope of VAT. And as long the goods don't move out of the designated zone, there is no VAT which becomes payable. The same provision is applicable even when the goods move from one designated zone to another designated zone. For example, the goods move from Jebel Ali free zone in Dubai to Hamria free zone in Sharjah, both of which have been defined as a designated zone. In this case also, there is no VAT which becomes applicable, and these transactions are outside the scope of VAT. However, to ensure that the goods are actually delivered from one designated zone to another designated zone, the designated zone from which you're taking the goods out, their authorities most likely impose conditions for you to pay either a deposit or a bank guarantee as a security to ensure that you supply the goods to another designated zone. And once you give the proof to the free zone authorities or the designated zone authorities that the goods were actually supplied into another designated zone, the bank guarantee or the deposit, the bank guarantee never gets invoked. And if you have paid a cash deposit, that gets returned back to you. It might be a revolving deposit, that's the purpose of mechanism. But to keep these kind of deposits or bank guarantees just to ensure that you do not give a declaration while taking the goods out of a designated zone that you are taking them into another designated zone and actually end up selling them into a mainland. So that's the reason these controls, which is the responsibility of the respective designated zone authorities, are being maintained. Now, a lot of larger groups and even the small and medium scale group, they have to look at their organizational and corporate structure, and they might considering changing their corporate organization structure than what they have been following for a number of years to take the benefit of reliefs which are available to designated zone companies, especially if your business is primarily into exports and imports. You would be way better off being in a designated zone rather than being in the mainland. Most importantly, from a cash flow perspective. So, as I mentioned at the beginning of my presentation, there are certain purposes or certain situations when designated zones are considered to be within UAE rather than being considered as outside of UAE. And the Article 52 specifies the exceptions to the Article 50 of this decree law. And under the executive regulation, the conditions are specified wherein the businesses conducted within the designated zone is regarded as businesses conducted within the UAE, and it will be subject to VAT. One of these examples is supply or receipt of services. So if a designated zone company is into provision of services, whether within the same designated zone to another designated zone or into the mainland, in all such scenarios, these services will be subject to VAT. Because as far as supply of services is concerned, the designated zones are considered to be within UAE and they're not considered as outside UAE. And this is coming out of exception, which is provided in the Article 52 as well as in the executive regulations. Now, the slide which you're seeing currently on your screens, that is a one-page summary which would clarify each and every single doubt that you guys would have in relation to treatment of VAT on the designated zones. It's a very busy slide, a lot of content into it, but if you understand and get a command over this slide, you would never get confused with what treatment to apply when you're dealing with designated zone. So we will go one by one and explain how the treatment applies. We start with supply of services. If the services are supplied by a designated zone company to another designated zone company, as I mentioned before, they will be subject to VAT at the rate of 5%. No benefit at all as far as supply of services is concerned. Similarly, if a designated zone company provides services to a mainland company or to a free zone company which is not qualified as a designated zone, in that case also, it will be subject to 5% VAT. However, if a designated zone company is providing services to a country outside of UAE or to a customer outside of UAE, and the benefit of those services is being availed by the customer outside of UAE, in that case, it will be considered as export of services and it will be subject to VAT at 0% because we all know that exports are subject to 0% VAT under the UAE law. Now, coming down and completing the services, on the inverse side, what we discussed is when it's a designated zone company providing services, and that's a supplier of services. Now, what happens when a designated zone company is receiving services? Similar to what is happening in case of supply of services, as a recipient of services, whether you're receiving the services from a designated zone company or from a mainland company. This is what you can see on the right-hand side of your slide. In both the cases, you will be required to pay 5% VAT if you are a recipient of services as a designated zone company. However, if you're receiving services from an overseas supplier, for example, you engage a law firm in UK for some legal advice, and they provide you legal services from UK into UAE. In that case, the supplier will not charge you any UAE VAT because they are not registered in UAE to be able to charge you VAT. However, as a recipient of services, even if you're a designated zone company, it will be considered as import of services for you, and you will be accounting for the VAT under the reverse charge mechanism. So services are quite simple and straightforward. I don't think there is any ambiguity, and you all will be clear as far as supply and receipt of services is concerned. The complications come into supply of goods, and we will consider on the same basis. On the left-hand side of the slide, we have treatment of supply of goods when it is supplied by a designated zone company to another designated zone company, whether within the same zone or into another designated zone. In both these cases, these transactions are outside the scope of VAT. And when we say they are outside the scope of VAT, it means they are not required to be reported anywhere at all in your VAT return because the VAT return is limited to reporting transactions which fall within the scope of VAT. A lot of companies are doing the mistake or having filed a return, having reported out of scope transactions on their VAT return based on some wrong advice, I would suggest. Coming down to the second aspect, when a designated zone company supplies the goods to the mainland, generally, if the mainland company is a registered dealer under VAT and it also has an import code, and the import code and the TRN are linked to each other, and the goods are cleared from the designated zone using the import code and the TRN of the buyer. In that case, the seller, which is designated zone company, is not required to charge any VAT at all to its buyer, and the buyer will be required to account for the VAT under the reverse charge mechanism. So these transactions again do not get reported anywhere in the VAT return of the designated zone company. If the designated zone company supplies goods to a country outside UAE, these transactions, since the designated zone is considered as outside of UAE for this purpose, a supply of goods by a designated zone company to a country outside of UAE is not considered as export of goods. It's considered as out of scope. And that is where it becomes very important. If you compare the difference between supply of service by a designated zone company to supply of goods, when a designated zones company supplies services to an overseas company, they're treated as export and they have to report in the VAT return and show a 0% VAT on those transactions. However, when a designated zone company supplies goods to a country outside UAE, they are not treated as export in your VAT return. They are treated as out of scope transactions, which means you don't have to report it anywhere in your VAT return. Now, on the right-hand side of our slide, we could see the supply of goods, which is when you're receiving the goods as a designated zone company. Now you are on the left-hand side, we covered when you are supplying goods, and on the right-hand side, we are covering when you are receiving the goods as a designated zone company. If you're receiving the goods from another designated zone company, whether within the same zone or another zone, then those transactions are out of scope. So you don't have to report those purchases in your VAT return. Similarly, if you are, or but however, if you are buying these goods from a mainland company, then as far as the mainland is concerned, for them, when they supply to a designated zone, they cannot consider designated zone to be outside UAE. And it's an obligation of the mainland company to charge 5% VAT on such supplies to the designated zone company, which means that the designated zone company will have to take the input credit of the 5% VAT charged by this mainland company to them in their VAT return. If the designated zone company imports the goods from a supplier outside of UAE, then those transactions again become out of scope of UAVAT, which means that you don't have to account for those suppliers under ASEAN. Again, important to understand the difference here between import of services and import of goods. When you import services from an overseas supplier, they are considered as import, even if you are a designated zone company. And you will be required to account for VAT under ASEAN in box number 3 and box number 10, respectively. However, when you are importing goods, you don't have to report RCM or any other reporting in relation to those imports if you are importing into designated zone and you do not take these goods out of designated zone. So as far as the first chain of transaction is concerned, when you import the goods, they're completely considered out of scope. Neither you're required to pay any VAT, neither you're required to account for the VAT on import of goods under the reverse charge mechanism. So the next slide is a list of 23 designated zones as they stand currently in UAE. Out of the 55 odd free zones, there are 23 which qualify all the criteria and conditions laid down under the VAT law, and they have been approved by a cabinet decision to be designated zones. Now, important part is this list is not set in stone. It's not something which will stay as it is. Initially, it was a list of 20 designated zones which was announced, and just around a few months back, 3 more zones were added into it. So it is very clear in the VAT law that this list will keep on changing from time to time, and you could see more designated zones getting added into this list over a period of time, as well as if certain designated zones are not fulfilling the required control procedures which they had taken the responsibility for. In those cases, they may be taken off this list as well. So those possibilities cannot be ruled out. And it's important any point of time, if you are analyzing and doing a transaction with a designated zone, please make sure that you look at the latest updated list of designated zones to ensure whether the zone still qualifies to be a designated zone or not, or whether a zone which earlier was not a designated zone has now been approved as a designated zone. So it's, as the tax law in any country would be, the UAE is the same case. You cannot live on some constant learning or constant knowledge. The knowledge and the learning has to be continuously updated. And this is one part of what you need to be doing. So if we look at, in summary, we have 4 designated zones in Abu Dhabi, around 8 of them in Dubai, 2 in Sharjah, 1 in Ajman, 2 in Al Quoin, 3 in Ras Al Khaimah, 2 in Fujairah, and 1 in Al Ain. So Al Ain is technically a part of Abu Dhabi, but since it's a separate free zone, which is defined as Al Ain International Airport Free Zone, so we have shown that separate. So this is currently the list of 23 zones, and you will have these slides with you on the Zoho website, which you can anytime refer for your as a ready reckoner, but with the caveat that they are the list of designated zones as on the date of this presentation. So this is again a summary of what we have covered previously. The areas which are defined by a cabinet decision as per the Article 1 definition, will be classified as designated zones. Generally, the designated zones are fenced geographic areas. They would have the requisite security measures to ensure that the goods don't move in and move out without appropriate controls. They would have customs control on their gates, so that because it's a custom authorities currently which is managing the VAT as well. So there is no federal tax authority officials which are sitting on the gates. It's the custom officials who are collecting the VAT from with the custom duty from you. They're the same who are seeing whether the VAT has to be paid in cash or you're allowed or to report under RCM. And if you're giving a declaration as a buyer that you will be reporting under the reverse charge mechanism, it's the custom authorities which update that into their records, and from there the data goes to federal tax authority, and you will see in your VAT returns in the box 6 of the VAT returns the output liability of any purchase you have made from a designated zone or from an overseas country, any import you have made. In box 6, for all imports of goods or purchases from designated zones, you have an output liability which is coming by default as a pre-populated number. So that's something which might not be absolutely correct. So you have to look at the list of the transactions which comprise of the box 6 pre-populated value, compare it with the actual custom documents you have, and in case there are any discrepancies, you make the adjustment in box 7 of your VAT return. But the procedure is very well working like a well-oiled machinery. 95% of the transactions which are reported in the box 6 are generally correct. There will be 5% discrepancies which you need to make adjustments in box number 7, but the data is becoming pre-populated, so there's no way around for you not to account for the RCM when you have imported the goods or you have purchased the goods from a designated zone if you are a mainland company. Also, another criteria which is important to qualify as a designated zone is the designated zones have to have a strict monitoring over the entry and exit of the movement of goods. The designated zones have to define their own internal procedures regarding the method of keeping, storing, and processing the goods. And the operators of the designated zone, the authorities which run the designated zone, they have to comply with all the procedures which the Federal Tax Authority has prescribed for them. Another quick summary slide on what we have discussed previously, but in a much bigger and a zoomed view. You have the transactions when mainland UAE companies supplies goods to a designated zone companies, they are standard rated subject to 5% VAT. An overseas company supplies goods to a designated zone company, it's out of scope. Designated zone company supplies to another designated zone company. But the important part is not a transaction between two companies, but where the physical movement of goods is taking place. As long as the physical movement takes place between one designated zone to another designated zone or within the same designated zone, in all these cases, the transactions are out of scope. Similarly, a designated zone company supplying to mainland UAE, if it's cleared under the import code and TRN of the seller, it will be standard rated subject to 5% VAT. If it's cleared under the import code and the TRN of the buyer, it will be accounted for by the buyer under the reverse charge mechanism. A designated zone company supplying goods to an overseas company will obviously be out of scope, as we had discussed before. Goods consumed within a designated zone. Now, we have talked about movement of goods within the designated zone. They are subject, they're outside the scope of VAT. However, if the goods are consumed within the designated zone, they become subject to VAT. For example, food items. There are restaurants within the designated zone. For example, in Jabali Free Zone, in Hamria Free Zone, you have got food courts, which supply food to people, which is supply of goods. Now, these food gets consumed within the designated zone. So this goods which get consumed within the designated zone are subject to 5% VAT, and you cannot take the benefit that a transaction or supply of goods happen within the same designated zone, so they're out of scope. No, in such cases, if they're consumed within the designated zone, the same applies for fuel, which is the petrol you get filled from petrol stations which are in designated zones. They are also subject to 5% VAT. The reason this exception has been created in the VAT law is to ensure that there is no competitive advantage to supplier of goods which are going to be consumed by operating out of a designated zone vis-a-vis operating out of the mainland. if you just see it from an example perspective, just compare a restaurant operating in a food court in Jebel Ali Free Zone to a restaurant operating just outside the Jebel Ali Free Zone gates. Now, if they had allowed the no VAT being applicable on a Jebel Ali Free Zone restaurant, then everybody from outside Jebel Ali would have gone to Jebel Ali to have their food to save the VAT. Similarly, if the petrol stations inside Jebel Ali Free Zone, they were not going to charge 5% VAT because the supply of goods is taking place within the designated zone, then everybody would have taken their cars and got their tanks filled from Jebel Ali Free Zone. To ensure there is no competitive advantage in consumable goods, this provision has been made that if the goods are consumed within the designated zone, then the 5% VAT becomes applicable. So this just gives in the technical definition, next slide which you have, on what are the conditions as per the Article 51 of the Executive Regulations, where the transfer of goods between designated zones is not subject to tax. There are two conditions which have to be met. First, the goods or part thereof are not released or not in any way used or altered during the transfer between the designated zone. And the second is the transfer is undertaken in accordance with the rules for custom suspension according to GCC Common Custom Law, which means that the requisite controls as prescribed by the customs are fully adhered to. The next slide puts the conditions in the cases where the supply of goods within the designated zone becomes subject to 5% VAT. And the condition, as I mentioned to you before, is that if the supply is made for use by the buyer or by a third person, then the place of supply shall be considered as the state, which means UAE, unless and until the goods are being bought for getting incorporated into, attached to, or otherwise form part of or are used in the production or sale of another goods located in the same designated zone, which itself is not consumed. In summary, if you're buying the goods for purpose of resale, or you are going to buy the goods for purpose of they being incorporated into or being used into production of another goods as a raw material, in such cases, supply of goods within a designated zone is not subject to VAT. However, if you're buying any goods for the purpose of consumption per se, then those goods will be subject to 5% VAT. The place of supply of services as well as place of supply of water or any form of energy, including electricity, will always be considered to be within UAE. And hence, supply of services or supply of water, energy, or electricity will always be subject to 5% VAT, even if the supply is happening from a designated zone company or the supply is happening into a designated zone. The supply of goods by a designated zone to a country outside UAE shall not be considered as export of these goods. It will be considered as out of scope, as we've discussed previously. Now, just to wrap up our session before we take up, your live question answers, we've just built up a few scenarios, which are basically coming from the real life scenarios of the client cases we have handled over the course of past 1 year. And I would just like to share it with all of you so that when you are applying these transactions, the best way is to make a flowchart similar to this and see what transaction you are actually entering into and apply the treatment of VAT accordingly. So let's start assuming you are a designated zone company and you are importing the goods from an overseas supplier. Let's say you're importing the goods from India. When you import these goods and you're a Jebel Ali Free Zone company, these goods will be treated as out of scope, which means you do not require to account for these goods under the reverse charge mechanism. Now, the goods are sitting with you in your warehouse in your designated zone. Now, possibly you can sell the goods either to another designated zone company, which is you may sell a good to a company or in Hamburgia free zone or a Jabrili free zone, or you may sell these goods into the mainland in UAE or to a free zone, which is not a designated zone, for example, a DMCC in Dubai. In all such cases, in first case, if you're supplying the goods to a designated zone, either the same or another one, they are out of scope. Again, you don't have to charge VAT. You don't have to report such sales anywhere in your VAT return. However, if you are selling the goods to a mainland company, you have to see whether the goods are being sold under the import code and TRN of the buyer, provided the buyer is registered for VAT. And if they're cleared under the import code and TRN of the buyer, you don't have a responsibility to charge any VAT to such buyer because the buyer will be obliged to account for the VAT under reverse charge mechanism, and the data for such clearances which the buyer has done will automatically become pre-populated in box 6 of his VAT return. So he obviously would have an obligation to account for that by default. Now, taking the chain a step further, assuming you had sold these goods to a country outside of UAE, you imported from India and you sold it to a customer in UK. In such case, your export will not be considered as an export. It will be an out of scope transaction, which means you will not report these transactions as zero rated sales in your VAT return. The scenario two, which again, as I mentioned, we are covering each and every scenario, whether you're a mainland company or a designated zone company, we have tried to cover every single transaction or scenario for you. Now, if you're a UAE mainland company who has a contract with an overseas supplier, let's say you are based out of Dubai and you have a contract with an Indian supplier and you place an order with them. Now they raise the invoice to you, but the Indian supplier raises the invoice on you, but they deliver the goods directly into Jebel Ali Free Zone. So the goods never, when they come from India on Jebel Ali port, they don't come to the mainland. They are straight away delivered physically from the port to your buyer, which is in the designated zone. Let's say your buyer is in Jebel Ali Free Zone. You're a mainland company, but your buyer is in Jebel Ali Free Zone. Now, your Indian supplier will raise an invoice on you. You will raise an invoice on your Jebel Ali Free Zone buyer. Now, although you are raising an invoice as a mainland company to a designated zone company, but since you have an evidence that physically the goods came directly from India or a country outside UAE and straight away went to your buyer directly into their warehouse in a designated zone, then such transaction, irrespective of how you do the invoicing in this model, the transaction is out of scope of VAT and you are not required to charge any VAT on that. Now let's take the chain a step further. Now the designated zone company to whom you had sold these goods, they again resold it back to a mainland company. Now the mainland company, if it is registered for VAT and it's clearing the goods under its import code and TRM, then again will account for VAT under the reverse charge mechanism. And as you could see, there are the transaction has happened. There are four parties involved in this whole transaction, which is in the scenario two. But throughout this whole transaction, at no stage the VAT becomes applicable because VAT is a consumption-based tax. Only if the second mainland company, which has bought the goods from this designated zone company, only when it sells the goods within the mainland itself now, only at that time they will be required to charge the VAT and pay the 5% VAT to the Federal Tax Authority. Till this point, what you can see in scenario two, throughout this chain between the four companies, at no point the VAT actually becomes payable because up to this stage, the second mainland company is accounting for the VAT under reverse charge mechanism. In nutshell, what we're trying to say is, if you structure your transactions properly and give a lot of thought process behind it, there's a lot of scope of tax structuring in a legitimate way, which you can do and make your business model more effective. We, as a consulting firm, have done it for more than 200 companies till date in UAE and have managed their cash flows and their business model in a much better way through some effective tax structuring, which is possible. Coming down to the scenario 3, on the supply of goods, assuming your company is a designated zone company, if they are selling to a registered buyer, we know there will be a registered buyer will account under RCM. However, if you are selling to a non-registered buyer, a company which is not registered for VAT, in that case, you don't have an option but to charge them the 5% VAT. The transactions without the rest of the world, which is export to another country or selling to another designated zone, remain same as before, which means they're still out of scope. The important part or the scenario which is different in this slide is selling to a non-registered buyer in the mainland or in a free zone, which is not a designated zone. In that case, the designated zone company does not have an option but to charge them the 5% VAT. The last scenario before we take up the Q&A session is on supply of services. And just in nutshell, as we mentioned, if you're a supplier of services, there is no difference between treatment of supply of services or receipt of services between a designated zone company and a mainland company. Now, coming to the scenario when you are a designated zone company and supplying services, whether to a registered buyer for VAT or a non-registered buyer or to an end consumer, in all cases, you have to charge 5% VAT. Even when you supply services to a designated zone company within the same zone or in another zone, you still have to charge 5% VAT. If you are supplying services to an overseas customer, in that case, you are required to treat them as export of services and report them in your VAT return as zero-rated sales. And similarly, if you're importing services from an overseas supplier, you will be required to report these imported services under reverse charge mechanism in box 3 and box 10 of your VAT return. So that's in a nutshell, we have tried to, given the time limitation we had, we have tried to cover almost every possible scenario which could be applicable in case of a designated zone. The real life, we might have even more complex scenarios, and we are always there to help you in sorting those issues out.